Hello, everyone, and welcome to another session of our SBH Investment Summit. My name is Alexis Can. I'm a member of the Institutional Relationship team at SBH. And joining me today for a discussion on the U.S. small cap landscape is Jeff Paulis, Senior Portfolio Manager and Lead PM for Small Cap Core and Mid Cap Core, Shaun Nicholson, who is the Senior Portfolio Manager on the Small Cap Value Strategies, and Brian Fitzsimons, Director of Small Cap Growth Strategies at SBH. So thank you all for joining today. I'm excited to get your thoughts on the small cap environment. I know it's an area that's always very top of mind for our institutional consultants and clients. So with that, let's get into our first question. So looking back at this year, 2022, what surprised you the most across the small cap market and the broader economy in general?
Yeah, I would say the biggest surprise for us in 2022 was really twofold. I would say first, it was the significant positive performance of energy names. And second, the degree of the collapse in valuations in longer duration growth stocks driven by the rise in interest rates. And I'll let Shaun and Brian dive deeper into both of those topics in just a minute. But the outbreak of the Russia-Ukraine war magnified both of these issues due to the impact of commodity prices. But when you combine the war's impact on energy prices in particular, with continued problem areas like global supply chains and the related product shortages that we saw, with continued labor shortages, which have driven wages much higher, you really had a recipe for accelerating inflation throughout most of 2022 to 40-year highs. And that acceleration in inflation forced the Federal Reserve's hand, and you've seen that aggressive response from the Fed and monetary policy over the course of 2022. And as those rates rose, valuation multiples fell, particularly in longer duration companies. And with that, I can turn it over to Shaun and Brian so they can discuss both of these points in a little bit more depth.
Yeah, I'll take the valuation compression side of the discussion, as it's been very meaningful, especially on the small cap growth side this year. Really going into the year, we had Fed funds rate that has increased materially, sitting at 3.75% to 4% today, up from effectively zero at the beginning of the year. And those higher discount rates that have been put into valuating the valuation work of companies has meant lower stock valuations. And I think the real surprise has been the magnitude of some of those moves this year. And given the move in rates, growth companies with greater future cash flows have struggled and lagged peers. And those reinvesting in businesses with limited current free cash flow, given the fact that they're building brands, building services, building products, those stocks have even struggled more. Areas like technology, software, which has typically been defensive in a down market, has been one of the areas leading the market lower, given this valuation compression. So it's been quite a surprise in the market. Growth stocks have taken the overall brunt of that valuation compression, but we do believe that we're through the worst of it at this point. Let me pause there and turn it over to Shaun for some comments on the energy side.
Yeah, thanks, Brian. The energy space it's been the best performer within the market this year. It's funny, the majority of that did occur, though, in a very short period of time. Post the invasion of Ukraine by Russia, oil prices spiked, energy stocks went up materially, but they've stayed at a pretty high level. When you look at the value space, energy as part of our benchmark was about 5.5% coming into the year. At end of June, it was near 11%. So it was clearly the significance of that move kind of underpinned by that volatility in energy kind of globally. So it's been something that I think has been a challenge across any product that has been underweight the space. But what's more interesting, actually, when you kind of step back, year to date, the price of oil is only up about 10%, but energy equities are up anywhere between 60 and some up 100%. So there has been a pretty big dislocation on a full year basis at this point of energy equities relative to the price. So it's something going into 23 that will be very interesting to watch.
Yeah, and let's talk about what else you're watching as we look ahead to next year. What do you see as far as what's going to drive the markets going forward? Are there areas of risk that you're concerned about, or what potential opportunities are you watching for next year?
Yeah, I'll jump in here and talk about kind of what we see as the risks, and then I'll turn it over to Shaun after that, so he can kind of end with more positive news than I'm going to discuss here. But I think one of the biggest risks that we see is really the lagged effect of interest rate increases on the economy and essentially corporate earnings. As many are probably aware, monetary policy works with a lag. So we believe that we really haven't seen much of an impact yet from higher rates in the economy. And at the same time, you have some warning signs flashing, from yield curve inversion in several key areas to what is now a sub 50 ISM PMI index, to the ISM new orders index that's at its lowest point since the outbreak of COVID. We've heard more cautious and subdued corporate commentary as well. And you also have, kind of digging down a level, you have very soft housing data, as higher rates have clearly impacted the housing market already. And that tends to be one of the first sectors that is impacted in a downturn. You also have had signs of slowing in areas like consumer retail, as the lower end consumer has been under pressure from things like inflation, as well as higher gasoline prices and energy prices in general. And then more recently, we're starting to hear and see signs of weakness spread to other areas, including transportation, particularly trucking so far. Container rates as well have meaningfully plummeted from a year ago. And semiconductor demand has also weakened. And all of these areas, whether that be housing, retail, transportation, semiconductor, or what we call early cycle, which means that they typically see the weakness in the economy first. And so the dominoes have essentially started to fall, similar to past cycles in some respect, as far as the weakness starting to pervade itself from sector to sector. And these concerns are really being confirmed in forward earnings estimates. Whether you look at the S&P 500 index or the Russell 2000 index, when you aggregate the earnings, they're declining. And so earnings estimates for 2023 peaked in the June timeframe, and they've been trending June of 22, and they've been trending lower ever since. And we don't really see much that can stop that trend over the next few quarters. And we're seeing more and more companies, both large and small, miss earnings estimates, revise their forecasts lower, and with higher interest rates still working their way through the tightening pipeline, as I talked about in the first question, we think forward estimates will continue to fall for the next few quarters, which is going to make it difficult for the market to keep rising like it has. And with that, I can turn it to Shaun to kind of give you the positive view or the offsets that we see.
Yeah, there's definitely some things that have been implemented going into 2023, if it is a recession, that have not been present in other recessions, actually going into those recessions. So a couple of government programs that you may be familiar with, the infrastructure bill. So that was really passed earlier this year. That spending, though, when you look at it, it's a 44% increase in spending on an annual basis for the next 5 years. So that spending is going to start hitting in 2023. And that's going to be a meaningful driver of some of the industrials that participate in that kind of infrastructure space. On top of that, you have the IRA, or the Inflation Reduction Act. That also has helped funding some new investments here in the U.S., particularly around supply chain. Lithium gets a lot of attention there in terms of bringing more lithium production into the U.S. But also there's a CHIPS Act in order to drive semiconductor investment here in the U.S. And all that is kind of correlated around a reshoring theme that's emerging just based on the geopolitical environment we've seen over the last, really this year in particular, but really with China and zero COVID lockdowns that emerged, and have continued in many respects. The reshoring theme, in order to eliminate some of that volatility, is going to be a 2023 story for many areas of the market. And so we really try to position many of our companies around these trends that are going to, in a sense, help to offset that recessionary hit through 2023.
Yeah, and that's a great segue to the next question of just how are you guys positioning your portfolios to help minimize some of these risks and also take advantage of the continued volatility? So Brian, we could start with you if that works.
Yeah, I think there's a few key things that we're looking at today, and I'll hit on a couple of those. First of all, given what we've seen from inflation, the prior discussion we were talking about on the valuation side of things, Strong free cash flow generation is a characteristic that we find incredibly important, especially on the small cap side. If we continue to see inflation remain stickier than expected and rates end up going higher, having current strong free cash flow generation is really important from a valuation support side of things, and that's going to be one of the key elements that I think is pretty prevalent on the small cap side. Another item is when you look at the balance sheets, we need to see strength in balance sheets within the companies that we're looking at investing in. It'll help them navigate through what is likely going to continue to be a challenging environment and even potentially more economic weakness in 2023. And really the impact from weaker cash flows as you go through that environment. And you combine that with the fact that now we're talking about higher interest rates. So it's no longer just a liquidity concern or a valuation concern when it comes to balance sheets, but it's real financial impact as you have to start to look at refinancing with existing debt that's coming due over the next 12 to 24 months, or higher interest rates with variable debt. So you've got an impact on cash flows that has now become very real as we've moved away from this zero price environment. And so the higher capital costs overall, we think, is something that is really an important part of the equation. So strong free cash flow generation along with balance sheet strength. And then the other element is having a long-term focus towards investing. And that really helps from being able to take advantage of valuation disconnects where fundamentals are better than what the market is pricing in, and we think will be more resilient. And so on the small cap growth side, we're looking at fundamentally stable growth. This is trying to create more consistent growth in cash flow per share. And on the small cap value and core side, it's continued focus on return on invested capital. So those are a couple areas that we continue to be focused on. We think will be important in the year ahead.
Yeah, I can follow on to that, and I'll have similar things to say to Brian. I mean, it's for us on the core side and the value side. It's all about return on invested capital, and by nature, free cash flow, as Brian mentioned, including for us both free cash flow growth, but also free cash flow improvement. And really, at the end of the day, we're firm believers that free cash flow is really the primary driver of equity value creation. And this is particularly true and important in rising and high interest rate environments. And Brian touched on some of the reasons for that. But also, I would add that with the 2-year near 4.5% and the 10-year fluctuating between 3.5% and 4% now, investors for the first time in years have alternative investment options to equities. And it's also, I'd say, important to note that the rise in rates also results in a higher cost of capital for companies, which Brian touched on. So free cash flow and free cash flow yields, the ability to self-fund, and just making appropriate capital allocation decisions and investments are much more important now than they have been really for the past decade, or even since, I guess, the post-GFC period, Great Financial Crisis. And so, as Brian mentioned, on the core side, we're positioning our portfolio and have been for companies that generate high return on invested capital, that generate strong free cash flow, and have good balance sheets. And all of these are really going to help weather any type of economic slowdown that we've been discussing here today. And also just generally will help our companies weather the higher rate environment that we have now. And I would just close by saying this is a time that active management can really shine. Investment managers, including ourselves, typically prefer companies with solid fundamentals or high quality attributes, including things like, as we've discussed multiple times already, free cash flow, high return on invested capital, strong balance sheets. If you take a look back from the Great Financial Crisis up until about 2021 or so, long duration stocks did very well. And you saw performance in areas like low or negative ROIC stocks, including areas like biotech. We had the meme craze at the beginning of 2021. We had the SPAC craze. All of these were kind of rooted in the low level of interest rates. And many of these types of companies can only fund themselves when capital is cheap and abundant. And that is in the process of changing, or some would argue that it's already changed. And so a lot of active managers, including us, really shy away from the types of companies that are fundamentally challenged from an ROIC perspective or a competitive position perspective, that we're just dependent on rates, low rates. So if rates stay higher for longer, or at minimum just don't revert back to where they were post-pandemic or post kind of Great Financial Crisis, we think that active management should continue to have the wind at its back here for some time.
Great. Well, just to wrap up our conversation, we have one final question, but this has been really great so far. So just when thinking about an overall asset allocation, why do small caps still make sense to have as part of an overall portfolio just in helping clients reach their long-term goals?
Yeah, I'll take that one. You know, when you think of the small cap universe, diversification across, both small cap core, growth, value, and just an overall portfolio, small caps bring a nice diversification element. When you think of from a risk standpoint, a lot of in a sense, the problems are emerging outside of the U.S. And small caps historically have a much more domestic oriented business model. And so I think from a risk perspective, it really kind of plays a nice role having that more focus at the U.S. Perspective. You know, there was a fact that came out from Evercore ISI that was quite interesting. Small caps are the only asset class since the 1930s to outperform inflation every decade. And so when you kind of step back and think of the inflationary backdrop that we've been in and that we'll likely stay in for a little bit longer, small caps still seem like a very logical place to have part of your portfolio invested in.
Great. Well, that is all we had prepared to cover today. Shaun, Jeff, and Brian, thank you again for joining. I hope those that have tuned in have found this to be helpful. And if there are any questions around what we covered today, please don't hesitate to reach out to your contact at SBH. We're always available and happy to discuss further. And we look forward to seeing you at the next summit.